before we start the roundtable officially. And so without further ado, I'm going to turn it over to Mark Robertson. And Mark's going to lead us through the introduction to the class, and then we'll start the class itself. Go, Mark.
All right. Well, good evening, everybody, and welcome to our April 23rd Investing Roundtable. We're going to actually start with kind of a special breakout session, honoring a little bit of St. Louis and Stan Musial. So I'm sure that probably plays pretty well in St. Louis. Candace, is that true?
Oh, for sure.
Yeah, the image on your screen is Busch Stadium, and that's a wonderful place to be.
Absolutely.
All right, so my name is Mark Robertson. I'm joined here by my dear colleague, Ken Kavula. Say hello, Ken.
Hello, everybody. Glad to have you folks from St. Louis with us, and glad to have all the folks that are from throughout the country with us as well.
And we have two very special guests here tonight, Candace Baker, who is from the St. Louis area. Good evening, Candace.
Well, good evening, and welcome to our city.
And our other special guest presenter is Kevin Gologly. Now, Kevin, I did sneak in one White Sox, so you might be comfortable with that a little bit later.
That will help, because Cubs is a four-letter word to me. I think all Cardinal fans can agree with that.
Well, I've been a lifetime Cardinal fan since the mid-1960s, so I can agree with that. So Hugh McManus will be unable to join us tonight. He's laying over on business in Philadelphia, and he sends his best wishes, and he ultimately will make it to one. So we're going to spend the first 45 minutes or so going over a special educational program. I'll switch to that now, and then we will come back at 8:30 sharp. We'll stick around for the entire time so we can field questions, continue conversations. Kevin and Candace, you are most welcome to chime in if you see anything that really, really grabs you or strikes a nerve in the presentation, the baseball-centered presentation. But
Okay.
Let's go ahead and get underway, Ken, if you're ready to go.
I'm ready, Mark. Let's do it.
All right. So I stuck the slides in back. There'll be those of you that access our slides. They're in the very back. So we're going to go over this notion of lessons from legends. And let's go ahead and get underway. All right. Like I said, I'm a lifetime St. Louis Cardinal fan, and I can remember the very end of Stan Musial's run as a baseball player. But this is just a wonderful tribute in Investors Business Daily. They have this leaders feature that they've run for years, and in this particular issue, they featured Stan. So we're going to kick off with Stan the man in St. Louis, and he is certainly an institution in the St. Louis area. I did have the privilege of going to a playoff game last fall, the last game that was played by Pujols and Molina, and it's just amazing the number of people that turn out. Candace, I suppose that the Cardinal attire industry is something else, because everybody's got Cardinal uniforms on.
Oh, absolutely. It's a sea of red.
It is an absolute sea of red, and it's really impressive. So what we're going to try to do is use some of the tips from about hitting, but as it applies to investing, as you'll see, we'll rein in Ted Williams and Warren Buffett for some more of the recipes. But Musial's approach to hitting was really quite simple. He's trying to hit it where there weren't people to get him out. So as Ken would say, hit it where they ain't. And it really is all about the percentages. And it was as simple as he tried not to hit it to center field. He's always trying to hit it down the first baseline or whatever. But a lot of preparation, a lot of considered practice. And Ken, you didn't get the privilege of seeing Stan in Cleveland, huh?
No, I grew up in an American League town, and we very rarely saw a National League team come in, especially in the American League town I grew up in. It was Cleveland, and you kind of were done rooting for the Cleveland team by the time June rolled around a lot of years. So there wasn't much inter-league play happening in the city. So I didn't really have Musial on my radar to any great degree. I was Mickey Mantle, Roger Maris, Bob Feller, Rocky Colavito, those kind of folks really were the ones that brought me to the ball field. I told you this afternoon, I attended my first Cleveland game when I was 7 years old and fell in love with the game. We sat back in the bleachers out in the sun, but I fell in love with it and never really watched it on television very much, because if you grew up in the time that I grew up in after World War II, then you're a lot of your memories center around, I think, watching baseball on the radio and picturing in your own mind what it looked like, because occasionally you had been to the actual field where they played and you could see what was happening, even though it was just that radio voice describing the play-by-play. So all in all, I didn't know Stan Musial. I knew the name, of course, and I knew that he was a top flight player. Mark, did he play with Nellie Fox?
Well, Nellie Fox played quite a bit for the Chicago White Sox, so maybe Kevin can help out there, but I'm not sure if they played together or not. But
okay, I just
no, I don't believe they did.
Maybe I know the name Nellie Fox because the White Sox, of course, are an American League team.
Yeah,
maybe that's where I know the name from then. Okay.
Well, the summary is he did a lot. I mean, he was basically an all-star every year of his career. One of the things that if I knew it, I had forgotten. He actually started as a pitcher. So much like Babe Ruth or the present-day Yohani Ohtani, pitching and batting, both. And he had a fantastic career until it was cut short by a shoulder injury, and then he converted to outfielder and amazing hitter. So he ended his career with a whole bunch of records, Hall of Fame, all kinds of most valuable player nominations and awards, and also experienced a few World Series championships several times around. And then just a few years ago, President Obama gave him a Presidential Medal of Freedom, and that's what is shown in the picture. So very accomplished, very respected, not only in St. Louis, where he is revered, but since passing away just a few years ago, I'm sure he's missed, but he certainly was quite active in the philanthropic community and just a whole bunch of different wonderful charities and that type of stuff. So again, he did a bunch of stuff. All right.
And
so
he was also featured on the very first cover of Sports Illustrated.
Yeah, I think we're going to have that here in a second. If it's
I have a copy of that.
1957, I think it was.
No, 53 at Sportsman Park.
Okay. Well, then he was back on it in 1957 again. So here's what I was talking about as far as he was actually a pitcher when he started, and he had a really good start. Probably headed towards being a dual pitcher, maybe just a pitcher, but these are some pretty good numbers, 18 wins and 5 losses. Anyhow, what it really comes down to is he liked to be quite serious about it, practiced all the time. But the thing that really resonated with me once again, and this goes back to the last 3 weeks during bull sessions, we've been talking about the book Thinking in Bets by Annie Duke and kind of a dual book report with Matt Spielman out of Houston. And in the book by Annie Duke, she comes up with a real parallel to investment clubs that she calls decision pods, where she would basically quiz and ask and inquire and basically do everything she could to try to get better as a poker player. And lo and behold, here is Musial basically doing the same thing throughout his entire career. He was kind of infamous for his willingness to sit down with people like Ty Cobb. There's a Detroit name for you, Ken. I'm sure he spent a fair amount of time in Cleveland. But it really did come down to he was willing to press these people, just trying to get better. And again, Annie is doing it with opponents, adversaries, anybody that would listen, and basically form an investment club-like type environment. And notice here it says that Stan was willing to even talk to people like Frank Sinatra and Harry James, who I believe was from St. Louis. So again, just this notion of use your community to get better at doing this stuff, and you never know what might happen. Your thoughts on this, Ken?
Well, I know we have a lot of slides to get over, so I'm not going to reminisce too much, Mark, but I do know that all of these great hitters are really famous for the amount of time they put into the game. It wasn't just a job for them. It was something that was a passion, and to get as good as they were, I see the quote at the bottom here, it's Musial saying, practice all the time if you're really as serious about ball playing as I was. So you don't get anywhere without that practice, that patience, and that discipline. And we're going to come back to those two words a couple times tonight.
Yeah, I think so. And gnashing of teeth, perhaps. Okay, this is a little bit of a busy slide, but I just wanted to make the point. There's a couple major points to be made here. First of all, he played all 22 seasons with a single team, the St. Louis Cardinals. And as you can see up at the upper part up here, just a whole bunch of awards, including a Hall of Fame, a number of batting titles and championships, and MVP stands for Most Valuable Player. I also note that he took a year and dedicated it to military service, as did Ted Williams, which we'll see in a minute. This is Stan and Ted on the cover of Sports Illustrated. This is one I thought you might be talking about, Kevin, from 1957. Both Stan and Ted were revered. Now, Ted did come to Cleveland, so I know that Ken Kavula is more familiar with Ted Williams.
Very familiar. That big old drafty stadium that Cleveland used to have, and Williams would come to town, and that stadium would fill up.
Yes, 76,000 seats. 76 was it?
It was closer to 90,000 seats, Mark. It was a huge, huge white elephant sitting on the shores of Lake Erie. It's not there anytime. Cleveland has a really nice ballpark now, but this ballpark served as the baseball and the football stadium for the Browns, and it faced the lake. The wind came right in off of Lake Erie. You could freeze your whatever you were wearing at the time. You could freeze yourself no matter how much you bundled up, especially in the bleachers.
All right, and then the main point I wanted to point out here is that in 1957, at the age of 36, where most athletes are fading a little bit, that's actually fairly experienced for a baseball player, and a lot of times they're looking towards retirement. He actually led the league in hitting. He was second in the MVP voting. And one of the reasons I bring that up is it is a topic that comes up under Buffett and Ted Williams' lists about you can accomplish quite a bit, even if you're a little bit further down the experience path. So that's there too. All right. So here, let's make the connection to Omaha, Warren Buffett, and Ted Williams. This is an excellent article from this Masters Investing series on the science of hitting. And we'll take a closer look at this, but this actually came up during the bull session today. Buffett and Munger often talk about this notion of you only have so many really great ideas during a lifetime of investing. You want to be fairly selective. And Matt actually mentioned the punch card. You know, you get maybe 20 or so instances of good ideas during a lifetime of investing. You should always be out there searching for those, but you're not going to have 20 or so every week. This is over a career of investing. So that's the point that is made. The photo that is there on the left, Warren Buffett actually has the cover of this in frame in his office in Omaha. And he obviously thinks highly of Ted Williams and his approach to hit and achievement. Okay, so here's what it is. Buffett actually, in his 1997 letter to Berkshire Hathaway shareholders, he completely channeled the thing around or embedded within that letter this notion of you don't have to swing at every pitch, and you should really be selective. And in the picture that you see on the left, that is Ted, and the strike zone goes from the knees to the armpits. And you see home plate there in the middle. So the strike zone is over the plate and within that vertical distance. And what Williams had done is basically showed where he gets the most hits, you know, basically the sweet spot, right down the middle of that strike zone. So if the pitcher were able to hit those kind of gray or brownish zone on the lower outside edge of the home plate away from Ted, Ted would be less successful. So he had to learn to not hit the pitches down in that zone. So again, it's just Buffett telling the story that you don't have to swing at every pitch and wait for them to come to you. Your thoughts, Ken?
Well, I think the patience that Williams is known for, and the patience that Buffett is referring to, is the one overriding thing that investment clubs can learn from what we're talking about so far. And it's, you go to investment clubs, and I know that a lot of you are in clubs and a lot of you have personal portfolios, and I just kind of sag a little bit when I walk into a club meeting and I notice they have 40 or 50 stocks in their portfolio. It just means that they're swinging at every hit, and they can't possibly have a batting average as good as the more focused portfolio. You have to learn to let some of the ideas walk right past you. In the last couple of years, a lot of us have been swinging at companies that don't make any money. And I've been quite vocal on you have to make money for a stock to have any value. And if your company's not making money, you shouldn't be buying their stock. It's as simple as that. That's pure outright speculation, pure outright gambling. And that's not going to serve you in the long run when we're finished with putting this portfolio to bed and leaving it to our heirs. I would hope there's not very many of those stocks that we bought that don't make any money and that disappeared in a fairly regular way, and that's what happens to them. I like this idea of swinging right down the middle, Mark, and I really like the idea of calling it the sweet spot. That ties it directly to a lot of what we talk about.
Absolutely. And then Ted also spends quite a bit of time talking about this zone, adding a couple inches to the outside of the plate, basically giving extra strikes to the pitcher. And there's a lot of hitters that do that. By the way, Musial and Williams were infamous for not striking out. I mean, they didn't just stand there, but they forced the pitcher to throw strikes. And the two of them would strike out from 30 to 40 times a season, which is really unusual. I mean, there are players in today's league that strike out that many times in a week. Okay, maybe 2 weeks, but
might be exaggerating just a touch, but
I don't know.
Good for
There's some guys out there now that if they don't hit a home run, they're striking out.
Just a bit outside.
Just a bit. All right. So here was basically the outline that was put together by Warren Buffett in that letter to shareholders. And this is what we'd like to use kind of as a launch pad to discuss some of these topics. And the first time Ken and I we wrote these out and sat down with them, we were kind of like, wow, there's a lot of things we could do with this list and those three themes up at the top of the page. And so Ken, what were your impressions as we were rolling down this list?
Well, my first impression was there's a lot of topics here. And rest assured, folks, we're not going to try to go through every single topic in the next 42 slides. We're going to be very selective in what we go through, but each one of them strikes a chord, strikes a bell, and each one of them could be developed, I think, into a really good set of lessons about how you become a better investor. It's as simple as that. And with, maybe starting with the one that says keep it simple. So that's what we're going to try to do tonight, is pick out our favorites and pick out the ones that we think give a good lesson to people that are in investment clubs and to people that are managing their own portfolios.
Yeah, and many of these inspire anecdotes or lessons learned over the years. You guys all know that I really do like the notion of keeping it simple, as Ken has already mentioned, but there's just a whole lot of stuff here that, we hear those words, patience, discipline, and just being choosy about the types of opportunities that we pursue. and then carefully take care of them. So let's go ahead and get started. We're going to basically spend the next 15 or 20 minutes going through these. Again, Candace or Kevin, if you're inspired by any of this to chime in, you're certainly welcome to do so. I'd like to start us with the last one. And
Mark, we have a good break point here, and I'm just going to give the opportunity to one of our audience who's patiently had her hand in the air for about 10 minutes.
Sure.
Judy Simonson, and Judy's decided that was an inadvertent hand. She's taken her hand down. So let's continue, Mark, okay?
So that's like an intentional walk or something, I guess.
Yeah,
All right, so I get to the bottom of the list, and the last thing mentioned by Buffett in this series was the goal is to make money, and I think it's a good place to start. And I don't know, Ken, over the years, we have started a number of presentations. I've thoroughly enjoyed the times when you have started on a Saturday morning and basically challenged the audience to think about, why are we here? You know, what are we here for? I mean, why do we join investment clubs? What is this all about? And I did resist the temptation to put Gordon Gekko on the page, but could have. And
what's so interesting, Mark, is when you begin a presentation like that you're going to work with the people on a half day or a full day basis, you very rarely start with the real reason why they're there. They give you all kinds of ideas of that maybe they think that the teacher wants to hear, but very rarely do you have somebody brave enough just to say, I'm here because I want to make money. And that's why people do try to learn about investing, I think.
Yeah, and the magic words are right up there. You see the words goals up at the very top. Have some goals. When it came down to Musial and Ted Williams and their hitting, they basically had an objective for how often they wanted to get on base and how many home runs they would want to hit. So again, they weren't going into a blind. Peter Lynch had a goal of outperforming the market by a certain percentage point when he was the manager of Fidelity Magellan. So again, I think part of our goals, part of the reason that we get out of bed is right there with the notion of a learn to invest community. If you wonder what investment clubs are really about, I think those 2 points are fairly spectacular. And that's really, in addition to having a nice, successful portfolio of our own, we would also like to see friends and family experience a similar adventure. And it's something we do not take lightly. And it's part of the reason that if you're here tonight, you probably share some of this aspiration.
And it's not the flip side of the coin, Mark, but it's a complementary coin, that when you have a community, when you have a group of people that are interested in the same thing you're interested in, they can help you in a very valuable way get through some of the periods when everything seems to be falling apart. It's not been an easy 2 or 3 years in the last 2 or 3 years in the market. We've seen things we've never seen before in history. We've seen things happen that we never anticipated were going to happen. We're dealing with a 24-hour news cycle, which means that those folks on TV have to keep talking about something, and sometimes they talk about things that are completely opposite what we've learned, and then half an hour later they're reinforcing the things we do learn. So it's important, I think, to have that community that you can rely on, to have that group of friends that you can discuss things with. If you're going to be successful, I think that learning from other people has to be continuous during the entire time you're trying to achieve whatever your goal is.
Absolutely. And I think it does come down, yeah, we'd like to be famous. Yeah, I did win a few statues at the February awards celebration. I'd like to do that again. But it also comes down to fortunes and simply this notion of freedom, economic freedom or financial freedom to do the things you want to do. And as we will celebrate here in a few minutes, the Roundtable has a pretty good track record, and a track record of sharing ideas. But in terms of setting goals, the goal's pretty simple. George Nicholson suggested that you attempt as a collective group and as individuals to beat the market by 5 percentage points. And that is a lofty goal. and it's achievable, but it's a bit of a stretch. But that is literally the target or the goal that we strive for collectively as a community. Now, the article on the right that you see there, that's actually an excerpt from Fortune magazine, and it's been run a few times. It's generally written by a skeptic that basically points out that we can't be doing this. I mean, it's virtually impossible to beat the market. You should just get index funds. But the problem is, Warren Buffett and Berkshire Hathaway have been doing it for decades. And there are many investment clubs I can point to that basically do beat the market over the long term, some of them by fairly handsome margins. In fact, Ken is in 19 clubs, virtually all of them. No. Put it
All
this
of
way.
them above
Ken,
average, right?
if you're at 19, which club did you drop out of?
No, but he is in
Let's
four.
keep going here, Mark. Okay.
The majority of them are beating the market, so that is the important aspiration to have, and it can be done. I'm tempted to write a freelance article for Fortune reviving this because they keep coming back every 10 or 15 years and saying that what Buffett is doing continues to be impossible. I think maybe they need to reassess that opinion. All right. So back to the list of articles. I'm just going to do some quick hitting here, and I'd like to grab the one that says understand batting average. So let's do that, because this actually came out of our sessions with Matt Spielman here in the last few days also. And again, a batting average is just simply how many times you reach base out of the number of times you're given the opportunity to do so. So if you do it and you get 3 hits in 10 at bats, that's a batting average of 300. Or 30%, if you want to think of it that way. So if you actually get out 7 of those 10 times, you're basically, quote unquote, I'm air quoting here, Ken, you're failing 70% of the time. Now, Ted Williams actually was the last person to hit 400. That's an on-base rate of, or hitting successfully 40% of the time. He still got out 6 out of every 10 times that year when he last did that. I don't remember the exact year, but Kevin probably does. It was probably in the 1940s or early 1950s. It's been a while ago.
I believe it was the early 40s, but it could be the 50s.
Mm-hmm. And one of the things that in this series where we were talking about Joel Tillinghast's book, Big Money Think Small, we were noticing some interesting statistics. Tillinghast, by the way, is the long-term, since around 1990 anyhow, manager of the Fidelity low-priced stock fund. So a mutual fund that he has run for a long time, and he has actually beaten the market by approximately 5 percentage points over that career. And one of the things that he pointed out is that a successful investor only has to be right about half of the time. And in fact, he with some research nailed down the number 55 is actually an exceptional performance for the number of selections beating the stock market. So we actually are going to modify our objective, which has been as high as 60, back to 55 for the roundtable portfolio. You can have pretty solid performance being right 55% of the time. And that's something that I know, Ken, you've often pointed out with respect to portfolios and the experiences that you've had.
Pretty graph, isn't it, Mark?
It is a pretty graph. I mean, keep in mind that we're only right about half the time as far as the selections that we make beating the market, but over what is now a 13-year period, bringing in about a 15% return versus a 9 or 10% return in the stock market. You beat the market by 5 percentage points. That's 500 basis points over an extended period of time, and wonderful things start to happen.
I'm getting some comments from folks in the audience that are kind of misunderstanding or misremembering what the goal of investment clubs was. And I have a couple of people telling me that the goal used to be to beat the market by 15%. That's not correct. Nicholson, when he started Better Investing, when he started at NAIC, suggested that a good, solid, working investment club should be able to do 15% compounded annual return. That includes the market average of 10 plus 5 more on top of that. The reason Nicholson didn't phrase it in terms like beat the market by 5% is that coming up with how much you beat the market in 1940 or so was really quite a daunting task with no calculators, no computers, and no real immediate access to a lot of data. Today, it's fairly easy, and any investment club can gauge their performance against a benchmark. Your accounting software will do that for you and do it for you in a matter of seconds. But the original goal was to have your return average 15% year over year over year, and that would come down to beating the market by about 5 points over a long period of time. So for those of you that are trying to remember what the original goals were, let's just start with reality. And what this graph is showing us is that our roundtable portfolio is actually approaching a 6% beat on the market at the moment. Our relative return, think of that as how much you beat the market. Our relative return is 5.7. So that's pretty decent, and we're moving into our 13th year. I'm sorry, we're finishing our 13th year in just a month or two and moving into our 14th year.
Yeah, and just a footnote, it really is important to measure the relative performance over time. If you tell me that your club did 13% or you had a 13% return during a period of investing, it's a whole lot different if the general stock market return was, let's say, 4%, while you did 13%. In other words, beating the market by 9%. But if you did 13% during a period when the market did 21%, again, you're underperforming. So again, that relative nature of comparison that's the reason for the plus 5%. And it's something that he insisted upon and pursued. Okay, so that's the batting average thing. Well, Ken is a stickler for discipline. So we actually noticed that there's 3 items here that are stick with, within, stick with, and stick to. So let's go ahead and take a look at those 3.
Well, and in order to stick to anything, you have to know what the rules are. And I think better investing, more than almost any other investing discipline, sets out a few pretty clear basic rules. And I really don't like this movement or this search for advanced investment topics and going past a good, competent beginning investor set of rules into intermediate rules and everything else, because I don't think they exist. I think that there's a set of rules and you learn them and they're relatively simple. And I think all you tend to do when you move into many of the advanced topics is you tend to fill your brain with a lot of stuff that isn't really helping your performance all that much. Know what you're competent in, and for Ted Williams, he knew what he could do and what he could do well. Same thing for Stan Musial, and stick with your circle of competence. You know, some people are great speculators, and if you find that that's a talent of yours, then I wish you well. If you find you're a great day trader and are able to make huge percentages day trading on a long-term basis, then I wish you well. But I like to have a life outside of investing. I like to sleep at night, and I found, I think, a methodology that sets the rules for me, tells me what I should be looking for, gives me a document to base everything that I'm thinking, to base it in a single document, and then says, when that document says one thing, believe it. If you've understood how you put the document together when it tells you to do something, then believe it, do it, come up with reasons why you should or shouldn't do what the document says you should or shouldn't do. Stick with the process, be disciplined. What more can you say?
Well, I'll tell you, I have a lot to say about this. I tend to, well, we'll get to that in a
I'm
second.
shocked by that.
It, it, but it really does boil down to, you guys think I'm some type of a cult follower when we talk about up, straight, and parallel. That is the mission. The mission is to get out there and find well-managed companies that have an opportunity to have fantastic success. And we literally are looking for these two trends or trajectories. The green one, or the trend line that you see at the top, is the sales over time at Apple. And the blue one is the earnings. And we really want to see those tracking pretty much up, straight, and parallel. We'll take a closer look at it. But what we really do as a community, what we do as a field of very active, opportunity-seeking investors who share ideas, is we deploy this notion of imagining. And you've heard those stories about Buffett putting his feet on the desk and thinking about what a company will look like in 5 years. We do the same darn thing every time we do a stock study. And it's where your imagination can meet that vision and you can see things. Again, a St. Louis theme, St. Louis Post-Dispatch and Pulitzer, and the story that we featured in our newsletter about 9 years ago. And the picture, which shall live in infamy, on the upper right is the presentation that Ken and I made at one of the national conventions in St. Louis. And again, I just really enjoy the Mark Robertson not pictured two guys talk stock.
Best picture I've ever seen in Manifest.
It wasn't 9 years, Mark. It was almost 14 years ago now, almost 13 years ago. And I just think it's time for you to get over it, okay?
Well, I featured it. Go ahead, Candace.
Oh, no, I was just laughing. It has been a while, yeah.
13 years. But I will tell the audience that I featured a photo of the Aurora Borealis, the Northern Lights, by David Carson this afternoon. So he is still with the St. Louis Post-Dispatch. And again, the story that we tell all the time is Ken and I are sitting there flashing up these visual analyses on the screen, the business model pictures of all these companies, and the audience is literally sitting there like a July 4th fireworks going, ooh, and ah, and tapping on their desk, or they're giggling when they see a stock with no blue numbers. And it was just hilarious because this photographer for the St. Louis Post-Dispatch pulled us over aside after it was over, said, is this some kind of cult? So we continue to have fun with that. All right, here's another company, and I think it makes the point fairly dramatically. Ken, I mean, this is what we seek.
I got involved in small companies when I first started dealing with better investing. I read the rule that said that you're supposed to have 25% of your portfolio in small companies, and yet I was going to all these different classes and all these different meetings, and nobody was ever talking about small companies. So I started looking for them on my own, and I quickly developed a rule. And it wasn't a rule that I found written down anywhere, but the rule was demand as much from your small companies as you demand from your large blue chip companies. If I can demand up, straight, and parallel from my large companies, I should be able to find small companies where I can find up, straight, and parallel. And here's one of the most successful examples of up, straight, and parallel being demanded from a small company. It's a small company that was bought out by a bigger company. But folks, that's not a bad thing. A buyout is almost always a really nice set of dollars in your pocket that you get when the small company disappears. There were also small companies that looked just like the giants that have turned into great medium-sized companies. My first home run in that area was a company called Neogen, where the graphs in the beginning looked just like this graph. They were going in an upward direction. The lines were just about as straight as they possibly could be, and they were parallel to each other. That just means, folks, that earnings follow sales and stock price follows earnings. That's all this means, up straight and parallel.
Yeah.
It's the basis, the crux,
And
the foundation of better investing.
the thing I'd like to point out is this was a relatively small company. The nutshell version is that the guy who formed the company did a bit of an end run around the underwriters on Wall Street, so they carried a grudge against him and the company for years to come. All kinds of negative press, that kind of stuff. The short sellers would go crazy on this company. And coming back to the discipline, what I found fascinating watching our community do was they're looking at this chart. They're looking at this chart continue to unfold, and they're looking at all this negative press saying, wow, that's a lot of noise and chaos out there. It could be true, but here are the operating results that we see. It enabled us to hang on to the company. Many of you in the audience have smiles on your face. You remember this company. Ultimately sold to Opco Medical down the road. So again, part of the discipline thing was to latch onto that. All right, we'll just knock out a couple more. I've got about 13 after. We can do a few more minutes. I thought what we do here is grab a bit of understanding history in this notion of watching others and speaking to people in the know, even when the people are dead. And here it's basically a situation with the triple play. Now, Kevin Galogly is going to do the triple play, so I'm not going to spend a lot of time on that. You're very familiar with it in general, so we'll just quickly describe it. But again, it's this notion of going back to the mid-1970s with George Nicholson, and he talked about lessons that he had learned from the 1937 to 1938 bear market. And in this case, he featured Coca-Cola on the pages of Better Investing magazine as a triple play. And oh, by the way, here is a stock selection guide embedded on the front page of a Value Line company report. Notice that the sales and the earnings and the cash flow are graphed there just like the visual analysis on a stock selection guide. I find that intriguing. So just very quickly, this is a more prominent weapon in our arsenal after things have been in a bear market for a while, but you're basically looking for three conditions. It's based on a baseball condition called the triple play, which is very rare, relatively rare, but you're looking for a stock that's on sale, that has improving perspective when it comes to margin enhancement and PE expansion. So as an example, basically we're looking for a company that has a formidable forecast for return, formidable return forecast. And you just have to answer the question, well, what's the average stock look like? Well, as of today, the average stock checks in at about 12%. It's the answer to the question. So you're looking for something that would be 5 to 10 percentage points better. So you're looking for a minimum of a 17% return. You also want to find a company that has the prospect of higher margins in the future. You guys all know the swoosh. And this is a pretty special condition that the analysts are looking for this type of activity from Nike. It's worth noting. And then last but not least, the opportunity for PE expansion. We've talked about Stryker in the past, going from 13 at the time to a projected future PE ratio in the 20s. And then, Ken, I couldn't resist putting your selection from last month, Avnet, in the lower left-hand corner, because it's not only expansion from 2022 to 2023 up to 2027, but they're simply going back. This level out in 2027, they're going back to something that's precedented levels that they have been at in the past. And I think that's an extra special triple play moment. Any comments or questions? Should we try to squeeze in one more? Yeah, let's do this one. This is a good one to close out. Dealing with losses. We all hate to lose, right? We feel at least twice as bad as the victories, believe it or not. I think it's actually more than two, but the academics tell us it's two. And we also want to handle some of these misconceptions. And this is rapidly becoming one of our favorite charts. There's a couple things that work here. First of all, Buffett does not believe in efficient markets. Inefficient markets, if you said that the market is efficient, you're basically saying that all the information is priced in. There's some inefficiencies. Inefficiency to us is simply opportunity. And our 10-cup portfolio at Manifest Investing is basically based on the quote from Warren Buffett: if the market was efficient, he would be a bum on the street corner with a tin cup. That is literally where that comes from, and inspires this portfolio. It zigs and it zags, but the general tendency is in the right direction, attempting to take care of things. And then this graphic on the right, Ken, I'll let you share your perspective on that.
Yeah, it's a graphic that I want to put in every single presentation I make until the day I die, because it says so much about this whole idea of investing and how many times you have to actually hit a home run. As of the last couple days, as of 2-3 days ago, the roundtable had made 728 selections of $1,000 each. That goes way back to 2010. And the rate of return of those 728 selections, some of them that we've closed, was almost 16%, 15.9%. 250, that's about a third of the selections, have current values less than the original $1,000. So a third right now of our positions that we've either closed or we still have open can be thought of as losing money. The cumulative loss for those 250 positions is just under $40,000, $39,000 and change. The average value of $844 for each of the losers. Meanwhile, I look at the biggest winner in the portfolio, and I'm only looking at a single winner, and that winner right now is Microsoft. We've chosen it 5 times, put in $5,000, and it's made $58,572. In other words, all of the losses are made up and then some by our single biggest winner. Remember that when you have a loss, you can only lose what you invested. But when you have a gain, you can gain unlimited amounts of capital. We put in 5,000 and Microsoft is still growing for us and still adding to our capital. Even if we lost all of the losing positions right now, we would more than offset it by 4 or 5 of our biggest winners. But right now it only takes 1 to offset every single loss. It's a powerful, powerful thought. What's important? You need the time to let your money grow and to let it compound.
Yeah, and it's such an important concept. I mean, every time I think through this, I literally sit here thinking, what have I ever been afraid of? You know, yeah, every once in a while they're not going to work out. Ted Williams and Stan Musial struck out from time to time, but not very often. And it's just not as frightening or fearful as it needs to be. Volatility is not risk. So with that, I think we can close down this session. I think we'll come back to this in some way, shape, or form. There's so much that could be formulated, but I am showing 8:20, so we probably want to leave a little bit of a gap for people to come and go, and we can field some questions, Ken, if that works. And while we're fielding questions, there is a White Sox uniform for you, Kevin.
Okay.
Right.
Thank you. Thank you.
I have a question from Debbie, and she wants to know, how can she get copies of the slides from tonight, Mark?
By sending an email to markr@manifestinvesting.com. That's one way. The other way, they will be posted. If you're a Manifest Investing subscriber, we always post the slides in the Manifest Investing forum. So those are the two places you can find them.
And we'll have it up on our YouTube channel as well. Our YouTube channel is, you can Google the word roundtable. You'll find it that way. You can Google the word manifest investing. You can put them together and Google manifest investing and roundtable, and you'll find our YouTube channel. Here it is right here. Every single thing we've done for the last 13 plus years is on this particular website, from the most recent to the oldies but goodies that are still there with us. So we urge you, if you go to the channel and you're not a member, join the channel. We have over 1,000 subscribers, and we'd love to have you as a subscriber as well. Join the channel that way. YouTube will inform you every time we post something new, and that'll allow you to go directly to the new post if you choose to. Cheryl is informing us, Mark, that after hours today, Microsoft grew 8.5%.
Oh my!
All right.
Those numbers just got bigger. You're going to see.
We'll have to revise our slide, okay?
I gotta check her numbers. I mean, I think I captured the portfolio. Here's the portfolio we were just talking about. It's part of tonight's program. I'll just go to it. This is the round table portfolio right here. Yeah, and Microsoft was already up to 71,000. I just wonder what was the closing price, Cheryl? Do you actually have that? This might have actually captured it.
I can find it.
And
okay.
And remember, folks, that 71,000 includes the original 5,000 investment. So if we're actually doing numbers, we've made 71,000 plus minus 5,000. How do I know we've put 5,000 into it? I'm using the legend up here on top, and you can see the 5X, and then next to the 5X, you kind of move over to the right and you see MSFT, Microsoft. So $71,451 minus 5,000. That's a pretty nice sum up for when did we start? We don't tell them when we started the position, do we, Mark? So don't have room on the spreadsheet right now.
Yeah, but we do have that. Every once in a while, we'll actually.
Yeah, we have the data, right? We're just not displaying it. Yeah.
The after hours closing price right now is $298.86.
Oh my!
It closed today at $275.42.
Okay.
And Cheryl's the president of our chapter, so I always address her as Madam President.
Madam President.
Being president of a chapter, you deserve that title.
The president of one of my investment clubs is at our class tonight too, and shout out to Mary. I'm so glad to see you here tonight, Mary. Glad to have you with us.
You know, Ken, Microsoft is going to approach the point where we have to talk about position size. Nice problem to have, but I mean, it's already at 13.7.
Yeah, that'll probably boost it to 14.5%, 15%, won't it?
It will.
Yeah.
It will.
Yeah.
Well, you know, Mark, you can trim it, and I think Ken would be more than willing to put it into A2 milk, right?
No, we don't talk about that company around here.
How do I mute him, Mark? I don't know. So, obviously, folks, we're just chatting right now. We will start the roundtable presentation right at 8:30. If you have questions, now's a great time to ask them. Anne is telling us that the first Microsoft purchase was in April 2011, Mark.
Yep. Yeah, there were 5 purchases between 2010, 2011, and 2013, I think.
Yep.
5 different times. Most of them inspired by Hugh McManus.
I think I might be responsible for one of them. I don't know.
I think you're one and I'm one, but I think 3 of them are Hugh.
But it was certainly something that nobody thought would have that kind of growth in a dozen years. I don't think I ever thought that it would have that type of growth in 12 years.
And for those of you that are wondering and are eager for updates in the biotech world, Hugh will be at a future session, either a roundtable or a bull session, to talk about Regeneron, Immunogen, and a couple others that have kind of ticked up on the radar screen. In fact, he gave me kind of a cryptic message today. He probably can't tell me what pharmaceutical he's visiting on this field trip.
I would like him to put Lilly on that list too. It appears that Lilly doesn't have just one huge drug well along in the trials. It appears Lilly has two
That's correct.
that could turn it into a just the biggest drug maker in creation, you know.
Yeah. And if you want to have some fun sometime, go back and see what Hugh had to say about Lilly approximately 5 years ago, when everybody else was basically throwing tomatoes at it.
Yeah. Ann is keeping track out here, Mark. Ann Manning, one of our participants from the Houston area. And Ann says, Mark, the 5 positions were 4 Hugh, 1 Ken, 0 Mark. Okay.
10 more demerits for Ann Manning?
And whatever he does, I'll reverse, okay?
Mark, how many times did you do A2 milk? I just wanted, just for those people playing at home.
At least once.
Okay. And how's Portillo's doing?
And Portillo's is cooking along very nicely.
Well, see, you know, you're batting 50%. There you go.
Yeah.
Oh, since we have the baseball stuff up here, I did look it up. So the last 400 season, Ted Williams was 1941. And I have to correct myself. I thought the first cover on Sports Illustrated was at Sportsman Park. It wasn't. It was at Milwaukee County Stadium. It was a left-hander, a Hall of Famer. It wasn't Stan Musial. It was Ed Matthews. Eddie Matthews.
Okay.
And it was in 1954, not 51 like I thought. So outside of that, I was right.
Yeah.
And are you running for president also, Kevin?
Cheryl is doing a great job as president. I'm very proud of being able to convince 3 different people to be president of our chapter. I'm happy just doing education.
I was thinking of president living in a bigger house a little bit south of where you live right now. So,
you know, that house is really not that big, just to let you know.
I have a hand in the air. Anitra, I'm unmuting you. Anitra, you're muted on your side, but if you unmute yourself, you can speak to us. Okay, I'm going to call that an inadvertent hand. Ann Manning, go ahead, Ann, you're on.
Mark, I'm just trying to keep you honest.
I appreciate that.
I don't want you to take advantage of saying you did something and you really didn't.
Yeah, and I really do appreciate that. I mean, I can't tell you how many times Sean Mace corrects me too, and I'll say something was a few years ago, and then he goes and looks it up, and it was like 8 years ago. You know.
Yeah. The reason I know all this stuff. Yeah. The reason I know all this stuff during the pandemic, when I was bored to tears, I went back and I made a list of all of the stocks that we did. So I have a list.
Maybe you can share it with Mark so he can help his short-term memory. And his long-term memory too.
All right, that's 20 demerits for Kevin.
Thanks, Ann. Keep that.
All right, I guess this will be my last time presenting here.
Mark, what time do we have on your watch there?
8:30, so we can go ahead and get underway. Do you want to kick us off for the formal session?
Yeah, that's good. I will do that. I'm going to count to 3 and then get us underway, okay?
Okay.
Well, good evening, everybody, and welcome to the April 2023 Investing Roundtable. This is Ken Kavula. I'm chairman of the Mid-Michigan chapter, and I'm joined with some very interesting people this evening. My good friend Mark Robertson is with us. I also am joined by Candace Baker from the St. Louis chapter. I'll tell you a little bit more about the St. Louis connection in just a moment. And Kevin Galagli is here, and Kevin is from the Greater Washington, D.C. chapter. He actually lives in the Washington, D.C. suburbs up in Maryland, and that chapter covers all that particular area. We've had them both presenting before, and they do wonderful jobs, and I'm sure you'll be very pleased to hear what they have to say this evening. Our good friend Hugh McManus has been held up at his job. That's becoming more and more regular, but Hugh will try to join us next month. And Cy Lynch had an engagement with his church that kind of rode right next to this one and had to beg out of the roundtable this evening. We're going to talk tonight about a regular roundtable. We've already run a class, and we're being co-sponsored by the Better Investing St. Louis chapter. And we hope that we have a lot of friends from St. Louis that have joined us this evening as well. Mark, do you have anything to add? If not, I'll go to the disclaimer.
No, just that we look forward to Hugh being back. And I do want to point out that of any session to miss, Cy Lynch is a rabid baseball fan. And unfortunately for the Atlanta Braves, but he really regrets missing this one. So with that, I think we can get underway.
We're going to just breeze right through the disclaimer. Everything we talk about tonight is for educational purposes. We're not endorsing for sale or for purchase any of the stocks we talk about. We'll try to remember if we own them in our own portfolios, but again, educational purposes, don't go out and buy anything without doing your own homework. If you'd like a reminder about the roundtable, my wife keeps a list. It's well over 1,000 members on that list now and growing. Drop a note to nkavula1@comcast.net if you'd like to be added to that list, or if you'd like to add one of your kids or one of your grandkids. They can participate. I have my grandson in one of my investment clubs, and it's turning out to be one of the most enjoyable experiences I've ever had in investing, and that's sitting down with somebody that's years younger than I am, and talking stocks with him and having him understand my vocabulary and having me begin to understand his vocabulary. If you need copies of the slides tonight, drop a note to Mark R. at manifestinvesting.com or drop a note to me at kkavula1@comcast.net. We'd also be glad to answer questions or to engage in a discussion. Just remember, I'm a volunteer and Mark has a full-time job. So this is a hobby that we're dealing with right now, and we devote a lot of hours to that hobby, but sometimes we're not sitting at the computer waiting for your question. We're doing other things. So with that, let's move on to the next slide. Our agenda is a standing agenda we've been using for almost 14 years now. We will talk about our results. We'll do a little bit of challenging some hot stocks that we might want to freeze the position of. We have selections from 4 of our knights tonight: Candace, Kevin, myself, and Mark. And then we'll take an audience poll and we'll let you take a position in one of the 4 stocks we've talked about. The question marks are next to Kevin at his request. I don't think they're there in any descriptive reason at all. They're just there because he didn't want you to know the name of his stock in advance. So with that, let's get on with it, Mark.
Raising the mystery level a little bit.
All right. We started this program a long time ago, and we started with the idea we were going to put together a tracking portfolio, and we were going to keep track of the tracking portfolio. We were going to meet once a month, and the original 4 nights, all 4 of them are still participating in the program. We've brought in a large number of guest knights and guest damsels to help us out when one of the knights can't make it. And we're so happy to have our family keep growing so that we can rely on a lot of folks throughout the country to help things stay on an even keel. We try to keep non-core selections. That's not up, straight, and parallel for you though that don't speak our language. We'd like to keep non-core selections to at least a quarter, but no more than a quarter of the portfolio. And we'd like to maintain a long-term return, relative return of 5%. In other words, we'd like our compounded annual return to continually beat the market by 5 points. We use the Wilshire 5000 to measure the market, and over history, that particular index has grown at about 10% a year throughout the history that we're looking at right now. So we're aiming for approximately 15% against a Wilshire that has been performing at approximately 10%. We're also focusing on trying to keep our win streak. A winning stock ends up being worth more than what we put in. A losing stock ends up being worth less. And we'd like our accuracy guide to stay at 55% or to approach that. I think as of tonight, we're at about 50%, so we're in the right ballpark. That red dotted line on this graph represents the relative return of 5, beating the market by 5 points. And you notice that since 2003, and that's as much of the graph as we've captured since that's wrong. Since our third year in the contest, we had a time when we were just at 0% performance. Somewhere right before our fourth year, we went and tested that 0 again, and we tested it again somewhere around our fifth year. But for the most part, the movement has been in an upward direction. We really took off at about our seventh year, and we've stayed, except for a little bit of time, we've stayed above where we're supposed to be. I think a lot of that 11 year plus there has to do with the pandemic. Right now, relative return, 5.4%. Rate of return since inception, exactly 15. Wilshire, 9.6. There's where the 5.4 comes from. Take the bigger number, subtract the smaller number, and you get the relative outperformance of 5.4%. Our accuracy has faded just a touch to just under 49% right now. So we'd love to get back on the accuracy train and at least push that above 50%.
One of the points that I'd like to make is that above that dotted line is actually pretty rare error. You're basically talking about if you take a look at the universe of conventionally managed mutual funds or exchange traded funds, I'm not sure what the exact number is, but it's somewhere between 3 to 5% of funds actually achieve those type of levels, and it really is quite an achievement to get up there. Again, many investment clubs experience that type of performance, and it is the objective. If you end up between 0 and 5, you're still beating the market and doing quite well. And if you're even slightly less, it wouldn't be the end of the world. I mean, I used to keep track of a lot of investment club portfolios when I was on the Better Investing staff. And even somebody checking in at the low end of the spectrum at 8% is still doing quite a good thing. And then there's those other Buffett beaters that are out there, but pretty strong performance. So don't let the concept or context be confusing.
For those of you that are new and are with us this evening, I want to stress that this is a tracking portfolio. It's not the kind of portfolio that a club would put together. It has many, many, many stocks in it because we pick 3 or 4 or 5 names every single month. And what we're doing is we're tracking our choices. We're closing those choices down when we feel they're no longer a good idea. And if you'd like to look at the entire portfolio, you can use that link in the upper right-hand corner of this slide right there. That's free. It's not going to cost you a dime. Just go to that link. You can see the entire portfolio. The legend in the upper left-hand part of the slide is telling you how many times we've chosen certain stocks. So for example, the 11X in front of BKNG means that we've chosen Booking.com 11 times. We've put a total of $11,000 imaginary funds into that particular stock, and it's our third largest holding. We probably have, I'm going to guess, 100 or so holdings right now, maybe even more than that. And if you don't see a name on the legend, but you see it in the chart, Costco is a great example of that. You can look and look and look, and you won't see Costco's name up there anywhere. Even though Costco is on our chart, that means we've only made one choice. It's only been chosen one time. And for a stock to be chosen just once and even make this chart of the top 18 or 20 is quite a feat. So if you have questions about the chart, questions about the accounting, questions about the dashboard itself, I'd urge you to, first of all, download the dashboard, take a look at the entire thing, and then drop us a line if you still have a question. We'd be glad to answer any and all questions about our performance and how we're calculating it.
You know, I just want everybody to know that I've thought about adding Costco many times over the 10 years or so it's been in the portfolio.
Well, that's interesting, Mark, because I'm gonna expand on that. We just bought Costco in one of my investment clubs. We felt that it had gotten to a place where it was a buy on our list, and within a couple days it was out of the buy zone again. I was looking seriously at Costco last Thursday, hoping that it had moved back into the buy zone and that I could add a second position in Costco, but I couldn't. No matter what I tried to do, I couldn't get Costco to be a buy again. So it's that kind of stock that maybe you, dare I use some heresy. Maybe you need to know when occasionally, and that's very occasionally, when to break the rules that you've set for yourself. And maybe a 2.5 upside downside is enough to get into a stock like Costco.
In fact, I think you're going to see that from Candace's selection tonight. It doesn't have a rip-roaring return, but man, does it ever have a solid performance over the years. So you'll see that when she presents it. Yeah, this is just the top 20. There's quite a few other ones in there. We are going to put LGI on the hot seat here in a minute. Good stuff. All right, I just redid the challenge page just a little bit to give you some idea of the things we think about for potential selling analyses. And Ken, I thought it was a good time to perhaps go back to the images, the graphic on the left, to describe the condition of the portfolio. And we basically
I like that, Mark. Yeah, I like that a lot. Yeah.
Yeah, we used to do this for our dashboard diagnostics program, and maybe we'll go back to a form of that. But again, we think in terms of these three main characteristics. Many of these are important on the screen, but we really want to aim for sufficient return forecast from the holdings in the portfolio. And what you see here is we're a little bit shy. The reason we're shy is because we've been doing pretty well here over the last couple of years, really. It's kind of hard to keep up with that target range, which ranges from 17 to 22. Right now, the average stock is right around 12. That's what you see here. So we are actually aiming to try to add stocks between 17 to 22. We'd really like to see the overall portfolio to check in closer to that type of level of 17. We're slightly less than that. Quality is fine. It's within the range. That's the range box that's shown there. We would like the overall portfolio to be in the excellent quality range. Anything above 80 is good. In the growth forecast, we toss around numbers, anything from 11 to 13 and change for the sales growth forecast for the portfolio, the weighted average. And you can see that we're actually in pretty good shape there. So we could use a little bit less growth, a little more quality, and we need to bolster the return forecast whenever we have a chance to do so. The portfolio insert that you see here are the 4 companies that have the lowest return forecast. Now, I'm not saying they're bad companies. There's some good or excellent companies on this list, but they do have the weakest return forecasts that you see here. And Ken, I'm going to basically say maybe it's time to part companies. LGI Homes, I'm tempted to name grandchildren after that company. I mean, we've only selected it a few times. It's up to almost $14,000, but it's been running pretty hard lately. Illumina is another great one.
I agree with you, Mark, and I could live with moving all 4 of these to the close their position. That would close what, 3, almost 4.5% of the portfolio down, and put a nice boost to our total par, I think, as well.
Yeah, it starts to make a little bit of a difference at that point. It's a little bit more meaningful.
Yep.
We do have some companies that have been selected that are lagging the market a little bit, but it's early, and I would argue that 2, if not all 3, are caught in a bit of a mob mentality. That's MOB mentality, and I don't know what's going to happen with the banks. I see that First Republic actually ended the day down 40% again today. So there's just some carnage going on there and some weird stuff happening.
And Mark, if you haven't had a chance to read the new value line about Clearfield, I would like everybody involved with the roundtable and those of you in the audience. Clearfield has just been added to the regular value line. If you thought it was an interesting play in January, I think it's an extremely interesting play right now, as its price has receded by about 35–40%. And I think that if you read between the lines in value line, you don't even have to read very carefully between the lines to see that Value Line thinks this is a greatly undervalued company at the moment, especially with the business that it has lined up going forward.
Okay, one of the other indicators that we use, we do not obsess over this, but it's simply to trigger a selling analysis for companies that have been hot. By the way, my Lululemon from 2 months ago is up about 40%, Ken. And I have you to thank for that.
Should we check with Ann to make sure that's correct?
We could do that. I think she'll back me up on that one. That one's inside my short-term memory window, so not too bad. But one of the things that we do watch for is a relative strength index greater than 70. Again, that's just the 14-day trailing. Just looking for a stock that's hot. And then another one that we'll check from time to time is that's a money fund index, money flow index, which is similar to a relative strength index, but it is volume weighted. So anytime that gets up above 80, these are the companies that show up as potentially overbought. And none of them are above 80, but Ollie's is closest, so is Gilead. Gilead is a difficult study. It's one of Hugh's favorite companies, but the problem that Gilead always has is they put themselves out of business every time they cure something. And it's really a wild business model where a company is developing solutions that actually cure sicknesses and disease, and they basically they don't have a continuing flow of pharmaceuticals like a conventional pharmaceutical company. So it's a tough one, kind of a tough one to manage, but they have been hot. Their money flow index has actually been above 80 recently. So maybe it is an opportunity just to give them a timeout. We can always bring them back.
Mark, I'm gonna suggest that we freeze the top 4 that you have bracketed, and I'm gonna pick one from the bottom list there also. That's Universal Health Services. I know the company fairly well from one of the clubs I belong to, and they're having some real issues right now, which I think is pushing the relative strength way over 70. That's UHS. And I'm going to suggest that we freeze that position as well.
Yeah, and that's been a very successful run since you added it to the portfolio a couple of years ago, but Ann can check me on that. Okay, so let's go ahead and take those actions. I think I will commit to basically showing how we're operating on the house money. I know you hate that expression, Ken, but the roundtable is operating on the house money now. Here's LGI Homes. And again, one of my favorites. The company has been rolling. It's been doing better than expected, but there is a bit of a, and again, I think the analysts could be pessimistic here. You can see a bit of a downdraft here in terms of the sales forecast for the next couple of years. And then it's also carrying on down here. So it's had quite a good price run and been quite good to us, but it's just under some pressure. Some of it could be imagined. Here's Illumina, kind of a similar situation. It's had a pretty good run. We've had this for several years, but you can see that the projected return on value is down in low single digits, and a closer look basically confirms it. Okay.
Well, and it's that way because it's been so successful. Its products have been so successful. This company has taken the time that it takes to sequence a genome from months to literally minutes now, and taken the cost of sequencing the genome from hundreds of thousands of dollars to hundreds of dollars. So it's been very successful, and is probably a product of its own success that it's trading at such a low potential. People have discovered it and are holding on to it.
Yeah, and you can see, again, these type of charts, they basically say that our method works. Here's a long flat spot in the stock price. Notice what happened to the par. And the stock price took off and went up, and look what happened to the projected return. So again, this is at a multi-year low, and that's why it's on the hot seat. So the stock price is hot, and the projected return has actually reached a multi-year low.
And you can know, Mark, that Illumina is on one of my look at first lists for the roundtable, and if it ever does come back anywhere near a buy, I'll be considering it for repurchase. So we're all set there.
And the other thing that does concern me a little bit is whatever is going on, a slight decline in quality up at the top of the page too. Slight decline, nothing major. So with that, we'll go ahead and take care of those actions. And any other questions or comments at this point, Ken?
We're getting some questions about why are we keeping the banks, and I think right now that I'm just going to rely on the buy low, sell high model, and I just am not comfortable when a mob takes over an industry, pushes all the prices down, and then everybody jumps in the bandwagon and tries to convince you it's time to sell. I'm just not comfortable in that position. If I were, I would have unloaded all of my bank down when they had been pushed down 60, 70% 3 or 4 weeks ago. I think some of the banks are starting to report. Some of them are reporting that they're very healthy. Some are reporting that they're having some issues. I don't think by any means that we're in a banking crisis, and therefore I think holding these two very high quality banks is still a pretty decent thing for us to do.
Ken, I'll just say that one of my two clubs, we bought another block of Western Alliance a month ago at 27. I think I just saw it close at about 37, 38.
About 37, 38, right?
Yeah. So yeah, I mean, we didn't get it down when it got all the way down to 7, but I think you're right that the stuff that some of the other banks are going through, regional banks, doesn't seem to be hitting Western Alliance. We didn't back up the truck and put everything in there. We had a lot of spare cash, but we did say let's support it because we know it and we follow it and we feel comfortable with it.
And please remember our disclaimer, folks, that we want you to do your own homework. We want you to draw your own conclusions. And if owning a bank right now, especially a regional bank, makes you feel uneasy, then maybe it is a great time for you to move it out of your portfolio and put that money to work somewhere else. We're giving you personal opinions in this portfolio. And my personal opinion, and I think Mark shares it, is that the banks right now are not something we want to take and jump off the cliff with.
Right. You know, and we've talked about this fairly extensively. I do think when you look at a company like Western Alliance, you can throw Charles Schwab in there too. And there's a number of companies, they have elevated return forecasts right now, but what you actually see happening, right, you know, with the the earnings reports coming in and them doing their full disclosures, which, by the way, Matt Spielman does a great job covering on the forum anytime that they itemize their situation and basically build a deeper understanding of what's actually going on at these banks. What I think you will see happen, in fact, I'm fairly certain, not completely certain, you can never be sure, but when their 2022 year-end numbers are actually in place with their book values and some of the stuff they're going through here in the first quarter, those forecasts are going to deflect down, but they're still going to look pretty good from a long-term perspective when that actually unfolds. Okay.
So we have some presentations to make tonight, Mark, so we should probably keep moving through them. And
all right. Well, let's go ahead and start with our guest damsel, Candace. Candace
Thank you very much.
This is a hometown favorite, so we have to call you a homer. I have to call you out on this.
Okay.
Missouri company that she's pushing here.
Right. Okay. This presentation tonight on Jack Henry was inspired by an article in Barron's saying that it was a baby thrown out with the bathwater from the banking turmoil. That it was also the cheapest valuation in years and can keep prospering even if banks continue to stumble. So I thought it was well worth taking a look at. The price at the time of the article was $148. Jack Henry is a mid-sized financial technology software company. It's headquartered, as Mark said, in Manette, Missouri. It provides integrated computer systems and subscription services used in mission-critical operations for about 8,000 small and mid-sized banks and credit unions. The CEO, David Foss, says almost anything you need to run a bank or a credit union in the United States you can get from Jack Henry. So it's a jack of all trade for banks. They manage the loans and deposits, do payment processing, electronic fund transfers. They're involved in the digitization of antiquated financial service operations, and they recently teamed with Google Cloud and MasterCard and a company called Atomic, which is a payroll connectivity provider. They are also rolling out an advanced financial crimes platform. They have a good reputation and a customer retention of 99%. Their software and services are non-discretionary type costs for a bank, making for the stickiness of their products. Switching costs could be a problem for some small banks. They have contracts that average about 7 years in length. The revenues may come from varying metrics depending on the contract, but none of the contract sales are tied to the value of deposits, which is important right now. They have 19% of the market share in the U.S. banks and 14% of credit unions. Next slide, please. This was a chart that I saw about the global trend for digital and cloud-based services. The study showed that U.S. consumers have more than 52% of their financial relationships with non-banks, which was surprising to me. For Generation Y and Generation Z, consumers, non-bank provide 65 to 69% of financial relationships, respectively. So Jack Henry helps these fintechs to integrate innovative solutions into the financial ecosystem. Next slide. It can take fintechs fewer than 90 days to integrate into their banking platforms and go live. Jack Henry currently has more than 850 fintechs already integrated into the ecosystem, and there's a lot of money in there, 132 billion funding in 2021, making up 21% of all venture dollars. Next slide, please. This is just kind of a highlight snapshot of revenues the last couple of years, and you can kind of see looks like up every year and pretty consistent. So something nice to look at. Next slide. this is the graph of the front page of the SSG, and as you say, you like up, straight, and parallel. I'd say this is pretty up, straight, and parallel. We do have that little glitch in 2018 for earnings per share, but that happens to have been the effect of the Tax Cut and Jobs Act. Most companies, we see that in 2017, but with Jack Henry, their fiscal year ends in June, so it came into effect for them in the 2018 fiscal year. I did show the latest quarterly figures we see for this is the second quarter of their fiscal 2023 year, which ended in December, and they had sales of 2.3%. Earnings per share was down that negative 15.4%. Now, they did explain in their earnings release that it was a really hard comparison on earnings, that actually the non-GAAP revenues would have been up 6% and earnings per share at 4%. What happened was that in the second quarter of fiscal year 2022, there were quite a bit outsized number of what they call deconversion fees. These are contract termination fees due to mergers and acquisitions, and there were too many in that quarter, and then it was a lot lower in mergers and acquisitions this time. So this is some of where the revenue came from, and it hurt them in that particular quarter. The next earnings announcement is May 3rd, so it's coming up pretty quick. It'd be kind of nice to see what's happening then. Next slide. I have a picture of the evaluating management section of the SSG, and you can see with Jack Henry, pre-tax profit on sales, pretty consistent, and last year was up from the 5-year average at 24.3%. Return on equity up and well over 20% with a 5-year average of 23.9. I think that 2018 would be an outlier there because of the effect of the the Tax Act. And then debt to capitalization is really low, which is kind of nice to see for a company that's involved with the banking industry. So all three of those metrics are really done well. The current price at the time I did the study was $153.96, and that was on April 14th. The 52-week high was at $212.62, the low at $139.28. So kind of in between there. I wanted to highlight that they do have a payout, a dividend. In 2022, that payout was 38.5% for a yield of 1.3. Their average yield is 39.3. The current PE at that price was 31.9 compared to the 5-year average of 36.6. So that made it a little attractive. And that 31.9 current PE ratio is pretty darn close to the 5-year average low for low PEs for this particular company. Next slide. I thought I would compare Jack Henry to two of the peers that Morningstar had for them, Fidelity National and Fiserv, just on the management area. And so first at pre-tax profit on sales, Jack Henry kind of beats the other two quite well. It is the green line on the top, so looks pretty good. Next slide. Here we are in return on equity, percent return on equity, and they're far superior to the other two. Next slide. And with the debt to capitalization, as we noticed, it was quite low for Jack Henry. And compared to Fidelity and Fiserv, they are well over the 33% going, and then Fiserv is actually at over the 45%. Next slide. So kind of looking at analysts' expectations, Morningstar does have it as a 4-star with a fair value of 174. So it is at the time, and even today it closed at 155.93. It's below that fair value amount. They do give it a wide moat, and they have capital allocation as exemplary. They had an 8% revenue growth. and say that Jack Henry is committed to the idea of slow and steady wins the race, and mostly because their growth is organic. Most of their competitors are growing by acquisition, and so sometimes they have issues of integrating those acquisitions that Jack Henry does not have to deal with. CFRA has a 3-star hold with a 1-year target of $180. That would be a little shy of a 17% increase from that one. I'll round it to 154 price when I did the study. Yahoo analysts had growth at 9%, 1-year target 174.40, 13 plus percent increase. Value Line's 18-month price target was 219, so quite a bit higher, and that actually from that 154 price would be about a 42.2% upside. They had annual rates sales growth of 5.5% and earnings at 8.5%. Next slide. This is a snapshot of the Value Line, and it came out in February 3rd. So there will be a new Value Line coming out. It'll be interesting to see what they say. I do see a typo there. The closing price, that should say 414.23 the day I did my study. Like I say, a little shy of 154, so that should be a 4 instead of a 2 there. But at the time that the Value Line came out, the price of Jack Henry was $180. So it's well off of that. You can see, though, it has a safety of 1, beta of 0.85, so it's not volatile at all. There again, you see that 18-month price target of 219. They show really consistent dividends being declared every year. And then the average annual dividend yield, they are anticipating to be about 1.4% out 3 to 5 years. We see with the net profit margins that they're predicting that they will be going up, so that's a good thing, increasing. So things are looking good. The company's financial strength is A+, and stock price stability, price growth persistence, and earnings predictability are all great for Jack Henry. Next slide. For my particular judgments, I estimated that the growth for sales would be 7% and earnings per share at 8. I did use the preferred procedure and kind of looked at the sales growth trends and the earnings per share growth trends. The preferred procedure gave me about 8.3% earnings per share growth. I just kind of was conservative and kept it at 8, but I think pretty reasonable compared to what their past history was as far as the historic trends that those screens show. Next slide. I made an estimate of a high PE of 32, which gave me a high price of 226.60, and I think that's pretty close to what Manifest Investing had as a high price projection. I picked a low PE of 28 and then selected that particular option for my low price of 135. That did bring me out to be a buy with an upside downside of 3.8 to 1, but the total return is shy of what we would like to see and below what the market right now could do. So that was a little bit disappointing. Next slide. I did bring up a comparison in the information technology services with Jack Henry, Fiserv, and Fidelity. I sorted on quality for this, and you can see that Jack Henry is the top one of the three. Pretty close was Fiserv. You do see that Fiserv and Jack Henry have some good net margins here, a little bit above Fidelity National. The growth is a little bit on the shy side from Fiserv, but remember back to those screens with evaluating management, it really was superior to the other two on those metrics. Next slide, please. This is kind of the price chart though, and it shows at, now this was when the price was 155 and it closed today at 155.93, so almost 156, so pretty close to where it is right now. It has really fallen off with the banking crisis, and the relative strength is at about 38, so it's down there, not quite maybe as low as what you'd like. So anyway, it has potential to go back to where it normally would trade, but maybe not with the return that we would like to see. Next slide. So basically, after looking at the Barron's article, there was not quite as much upside to the stock price as I anticipated from the Barron's article. But Jack Henry is still a really good, long-term, well-managed business. It's trading at a pretty fair price. There is some modest upside potential to it, and it does pay a dividend. One thing to keep in mind for this company, that even during the 2008-9 financial crisis, Jack Henry reported positive returns. They offer non-discretionary services that banks rely on. They can benefit from banking fallout as depositors spread their cash across more distinct banks, especially for the accounts where revenue is dependent on the number of accounts held. And banks will continue to invest in IT in order to remain competitive and efficient. So pretty sticky business that they're in. And then they have the growth that will come from the modernization process from on-premises computing to the cloud and helping the fintech developers.
Very good.
And
Thanks,
that's
Candace.
it.
You know, the one thing that I would point out is this is probably an example of the type of company that does, the one we always talk about is Johnson & Johnson. Johnson & Johnson is rarely a screaming buy. So you have to modify your thinking a little bit. I think that's what Ken was hinting at when he said maybe you bend the rules a little bit. This is a blue chip stalwart that's extremely well managed. So maybe the expectations are tempered a little bit for a company like this. So
well, I think I have to agree. I was just looking at Value Line, and in over the past several years, the stock really, the lows are like 155, 141, 123. You know, it's pretty fairly priced compared to where it's been.
Yeah. All right. Well, we'll keep pressing on. Thank you, Candace.
You're welcome. Thank you.
All right, Kevin.
Hello, everyone. I'm Kevin Galogli. I'm in the DC regional chapter. And Mark gave me a lot of lead time to be able to do this. He called me on Friday afternoon and said, do you have any good ideas that don't include leather? Yes, Ken, you're absolutely right. And so I started giving
I tried to talk him into Wolverine worldwide. Wolverine.
Well, those are hush puppies. I think the picture I sent back to you was not hush puppies. Anyway, so what I decided to do is we were chatting and I had a couple different ideas of stuff. Was a couple of them, they had actually sort of fallen out of where they were in the buy. And I said, well, let's try the triple play screen, because I remember talking with Mark about creating that as on Manifest. I don't know, when did you put that up? About 7 to 10 years or so ago? Is when that metric went on in there?
It was a few months ago, anyhow.
Anyway, but the thing is I said, well, let's try that. So I'm going to show you, come up with an actionable stock idea using the Manifest triple play screen with some other metrics. So let's go to the next slide. And so again, we had this earlier today. You can take a look at some of the metrics that are there. And one of the things to keep in mind is that the undervalued feature, a lot of times those are triple play possibilities. And as we were saying before the class that started at 7:30, is that the DC chapter and the Maryland chapter get together on the first Monday of every month, so this upcoming Monday, and we look at the stocks that have been featured in the stock to study, the undervalued feature, and some others. And the undervalued feature is always in there. And they really have outperformed stock to studies over the 2.5 years that we've done that. And we do have a tracking portfolio over at Manifest. But there's a link if you want to come join us. You can sign up through the DC chapter. And I actually noticed that there's 7 of our presenters that are people that have presented at that webinar that are in the audience tonight. So thank you all. So let's go to the next slide. So here's the screen that I did, and I did this on Friday, as you can tell. And so I start with the triple play, and I usually like to put in a couple other metrics. I put in sales growth, I put in the core score, I could have used a quality, and then I like to use sometimes a Motley Fool because while they're long-term, they're a little bit friskier than us. And if you want to learn a little bit more about that, there's the Motley Fool link to it, and then Mark wrote about it as well. And so generally when I get a screen, I like to find somewhere between 10 and 20 stocks. I want to have half of them that I have some kind of passing knowledge of. It doesn't mean I've done a presentation, but I've heard someone talk about it either here or 5 and 5 or somewhere else in my clubs that have taken a look at. And so I can do that with this one. There's only one of these that I've actually done a presentation on before tonight. And what I did is I looked at the industries, and what really stood out to me was I saw semiconductor equipment and semiconductors. And I said, let me take a look at those. And I know Mark said that last month cited Taiwan Semiconductor, but if it's still good, we can take a look at it. So that's sort of how that's my starting vantage point. And let's go to the next slide. And here's what they all look visually. And this is what I like to do is I sort of like to hide the names so you can just look at the lines. And I'll ask our other knights and damsel, which one do you like best out of all of these? Ken, Mark, Candace, what do you like?
I like A and B, both.
Yeah.
Yeah,
Candace?
I like B. I like B.
Okay. Anyone in the audience pipe one in?
Yeah, and I think A might be less vulnerable to that bump up in 21 and 22. Sometimes those bumps go away.
And so again, we use the core score, so that shows good quality. We see quality in these lines here. We're seeing growth of at least 9%. And we're seeing, again, that outside of maybe E, where the current price is right at the 52-week high, you know, and C is fairly close to the current part of the 52-week high. Outside of that, they all look pretty good. So let's go on, and I'll show you eventually which one's which. So here's one of the things you have to keep in mind with semiconductors is that they're in a highly cyclical industry. And a lot of people don't know what it is, but you know, again, it's like they tend to improve faster when there's increased spending. If you have, you know, they tend to be more for discretionary. So for and our line, it would be like travel, entertainment. In businesses, it's whether they're going to be spending more on particular things. And if you want to understand a little bit more about cyclicals and that visual analysis, here's a shameless plug for the virtual Bink, where there will be a class on visualizing the cyclicals. So come and take a look at that. And please sign up and join us. But you know, you have to sort of keep in mind that sometimes these things are not going to look as up, straight, and parallel, and you're going to have to use, there can be some subtlety that goes on with it. So let's keep going. And I also like to look at, you know, we just did in our own webinar, we look at the top 100 in April. And if you look at that, goes all the way up to the top 200. Look at all those semiconductors that are in there. NVIDIA, Intel, AMD, Qualcomm, on and on and on. And the other thing is if you look over on Manifest, the industries over on the right-hand side, 4 of the 5 stocks that I just came up with that screen are in there. And Mark, if you can mark them off under semiconductor equipment, KLAC is one that was on the stock screen. LAM, LRCX was there. And then it was a Kafka Sufa, that's KLIC down at the bottom. And then in the semiconductors itself is Taiwan Semiconductor. So 4 of the 5 were in the top in there. So it tells me that I'm really fishing in a good spot. And here's the thing to sort of keep in mind. A lot of people don't understand is that there's, when I was doing some of my research on this, 1,400 to 1,500 semiconductors in an average automobile. And you know, the bottom link there, chips are the new oil. That was a story that's in the Wall Street Journal, but it also showed up in Investor Business Daily and in Fox News, and it may have even shown up in Barron's, and they're all owned by by Rupert Murdoch. But the fact is I think that's absolutely true to sort of keep an eye on those things. But we're fishing in a really good spot. So let's keep going. As an elevator pitch, it's material for electrical conductivity, and it's only been really commercially viable since the 1960s. Intel and National Semiconductor were the first ones. And here's the thing: look at how many chips were in 2020, 930 billion, and they're expecting over 1.1 trillion to be made in 2030. And all of those things are necessary because semiconductors are the brains of all the electronic devices. It's not just in the computers and TVs and your smartphones, but now it's in your household appliances. Even if you have a rice cooker, it's in that. And to give you an idea of the size of these things that are going on is if you look at that, the nanometer size, there's pollen over on the left-hand side of that image. If you can sort of check that, Mark, that's pollen. The nanometer over on the far right, if it was on your fingertip, you couldn't even see it with the naked eye. The 1 nanometer over on the far right, the far right side. That's how small these things are. So you have to have very precise precision equipment to be able to do this stuff. Let's go to our next slide. So the thing is that we sort of lump, and I'll have to be honest, until I've really started looking at semiconductors in the last couple of years, is that I really couldn't tell you the difference between any of them. Well, some of them actually just design semiconductors. They're called fabless. That's like NVIDIA, Qualcomm, and Broadcom, AVGO. Then some of them are just foundries, or they make it. That's Taiwan Semiconductor. Some do both, integrated design. And some of them are just equipment makers like KLAC, Lam, and Kafka, whatever the other one is. And so what you can really find with these semiconductors is they're really a modern day pick and shovel, and that they have a lot of stuff that's going on. Candace was just talking about how there's steady performance out of Jack Henry. You can see this in a lot of the semiconductors as well. Next slide. So here's what I did. This is company A. Company B was Taiwan Semiconductor, by the way. And so if you look at this, again, up straight and parallel. The problem is that I sometimes have trouble understanding all those words and buzzwords that are in there. So there's the description. They talk about being yield management and process monitoring, diagnostic and control systems. Sounds like they could have made that. It sounds like they could work for the government or the military with how, opaque their commentary is. But semi-PC doesn't mean semi-PC doesn't mean personal computer. It's process design and control. It's a sub-industry. And what they do is they have KLAC. It used to be KLA 10 core, but it's KLAC, which is a corporation, makes a highly specialized equipment that they sell to manufacturers that are doing this stuff to help eliminate errors and correct mistakes. That's the yield management during the process of it. So what happens is that the companies that take their equipment, they're able to save time and money because these really, really tiny chips they're able to correct very quickly with their process control, their process design and control. Next slide. So here's again, and there's one of the machines in the upper left-hand side. And they have the largest market share in this semi-PC, and they're the only pure play, which means this is all they do. And you can see in the graph, this is from their own investor day, they have over 50% of the market share here. And if you look at that, the other competitors, they don't mark there, but the ones that are their competitors are Applied Materials, Hitachi, which he can trades over the counter, but those two also do stuff other than just doing these semi-PCs. And then the third one is Onto Innovation, which is in the S&P 600. So you can see that they dominated in the market share as long as they continue with the innovation, and then they capture all that information in terms of where the errors are so they can improve their product when they go back out. So next slide. So again, this comes from their investor day. And here's sort of what to take a look. In the upper left is you can see, all right, we think of PCs and we think of phones and all that and the big data. But everything from 2020 to 2030 in the upper left, can you circle that? That purple one right there. Those are all the things. So all this stuff that's talking about Internet of Things, or how robotics are going to change everything. The robotics can't work without a semiconductor. AI, 5G, none of that can work with that. And so this is why you're going to need people to make semiconductors, and you're going to need someone who's going to be able to check to make sure that they improve their They don't make mistakes, yield management, and that's where someone like KLAC comes in. And over on the left-hand side, lower left, you can see that in the last 2 years, 60 new fab projects, fabs are manufacturing product, 10 because of the CHIPS Act in North America, but 48 in Asia, and not all of them are in the People's Republic of China. They're in Taiwan, but they're in Korea, Japan, Malaysia, Vietnam. And so there's a great opportunity for KLAC to continue to grow with all of this stuff going on. There's going to be both demand for semiconductors and then demand because of these new facilities going out. So a great way to continue to drive their product. Next slide. So if you look at the strengths, again, Morningstar, it has a wide moat and exemplary capital allocation. I find that very, very rare. They have 50% market share right now, but it is cyclical, although maybe it's stabilizing a little bit. They do carry a little bit of a higher debt, but when I was reading some of the stuff, no one seemed to be that concerned with those higher debt levels. They have to stay innovative to be able to make sure to keep their competitors away. I saw one of their slides, and it was some unbelievably high number of people that work for KLAC that are that have PhDs, which is not unsurprising. So you're not maybe going to get that super big growth, but you're going to get a good steady growth. Again, a classic pick and shovel play. Next slide. So rather than doing all the steps in the SSG and the like, what I did is I just showed you my judgment. So I'm going with 7% sales, 8% for earnings. You can see where I have my high in low PEs in the future, but you can see I'm thinking I can get a 4-to-1 upside downside ratio, potential price appreciation over 100%, total return on the high side 16.5. The par is 11 on my SSG. And if I compare that to what I see in Manifest, where they have a par at 10.4, and on top of it, I like that the Motley Fool's cap rating as being a 5, which means they're very bullish in the Motley Fool community to take a look at it. And again, I was doing 8% growth, and here we see in Manifest that they're suggesting maybe 12.3%. So overall, I think there's a lot to be able to like about this to go forward. We got one more slide. All right, I didn't give you a step-by-step. Don't worry. What I just did before this went on, we started this, I submitted a first cut. So for those of you that are BI members, you'll be able to see it whenever they get it out there. You'll be able to see all my judgments in complete. If you want to be able to see more about semiconductors, like I said, the monthly webinar that we do, you can see all the times. We're going to do Taiwan Semiconductor on Monday, but we've done Micron, Enphase, Qualcomm, Monolithic, all of them, and they're up on our YouTube page. So once you're done clicking on Manifest, come on over here, subscribe and like those things, because that's how those algorithms work, and you'll be able to see it. So that's my position on KLAC.
Very cool. Thanks, Kevin. All right. Ken, take us away with Fabrinet.
Well, here's the front page of the Fabrinet website, company website, and doesn't tell you very much about what they do, but it's a pretty picture. Next slide, Mark. Because it doesn't tell you very much, I copied the thumbnail that comes right with the SSG Plus, and this is not as opaque as maybe the description that was with KLAC 10-core there, but it certainly is still using a lot of words that a lot of us might not be familiar with. I think it's maybe best if we looked at some of the products and we looked at what they do. It's principally engaged in providing manufacturing services. It's not selling to individuals. It's not selling in a store. It's selling services and equipment to OEMs. That's original equipment manufacturers. So it's company to company, business to business, a wide range of products, and those products are divided into various divisions. Next slide, please. Global leader, advanced precision optical, electronic, mechanical, manufacturing services. So it gets involved in the actual manufacturing of a lot of high-tech equipment, and it provides solutions for that manufacturing. It provides tools that are used in the various kinds of manufacturing. Relatively new company, founded in 2000. The founder is still part of Fabrinet, part of the company. It does have a presence in China, but it's doubling its bets by making a presence in other parts of Southeast Asia as well. You can see that they also have a presence in the Middle East, in Europe, and a significant presence in the United States. A long-lasting customer relationship with programs. Fabrinet, once it begins to provide tools and materials, tends to be very sticky with its customers. And again, that sticky is something that is very important to a company. Customers hate to change when they have something that they're using that seems to be working well, and that gives Fabrinet a little bit of pricing power. They do have a narrow moat when you ask Morningstar about the moat, and they have a management team that's been around with the founder for about 20 years plus now. Next slide. Here's the divisions that they work in, and some of these words might be very familiar to you, and some of these words might make no sense at all. They have a complete division devoted to lasers. LiDAR at the top of that automotive division is the radar-like sensing that uses a laser rather than some other beam to bounce off to determine distance from an object. LiDAR is going to be used a lot as we move into cars that are more and more autonomous. I like this EV charging stations. They have a lot of tools that they're devoting to developing EV charging stations that will charge more quickly than the ones that are available right now. They do a lot of work by creating LEDs and then by turning those LEDs and the laser lighting into tools to help you manufacture other things. In the optical sensing, you might not be familiar with AR or VR. That stands for virtual reality and augmented reality, something that you would see a lot in the metaverse as you begin to move in that direction. Very interesting, and again, they're going to need lots of tools to create these virtual and these adaptive environments, whether it be for gaming or for manufacturing or for learning or whatever it's for. There's a lot of tools necessary to put these together. They're doing a lot of work in medical diagnostics as well. Remember, they're providing parts, they're providing materials, they're providing pieces. It looks like those are pretty jewels down at the very bottom of the slide. That's actually some of the material they provide for other companies to use to make industrial prisms, industrial lasers, and various other things. To us, those look like pretty red jewels we might make jewelry out of, but very important industrial components that are being used by all kinds of customers. Next slide, Mark. Here's Fabrinet looking at it from Manifest Investing's point of view. It is a 5-star cap as well. Manifest is suggesting 13.3% growth. Notice that average PE ratio down there of around 19. That'll come back to us in a little bit. Just kind of keep that in mind if you would. Next slide. Here's our picture coming from the SSG Plus, and I've used one of my favorite tools on the SSG Plus. There is no regular value line report for this company. There's a very short Morningstar set of data that goes with this company when you look on the Morningstar site. And finding projections for a company like this is fairly difficult. There is a small and medium-sized value line report for the company. And what that report does is it gives us projections for earnings for the end of 2023 and the end of 2024. I went into my tool and I erased, well, there was nothing there. There are no Morningstar estimates, so the grid was completely blank, and I filled in earnings estimates for 2023 and 2024. And then when I went back to my analysis right here, I got two nice dots. All I had to do was go to the legend that's in the kind of lower right-hand side of this slide, and I made sure that the sales detailed estimates and the EPS detailed estimates were turned on. Turn them on, I got those two dots, and that gave me some reassurance that my estimate, my judgment on sales growth was at least matching the value line source. Not very much information to go on in this particular company. I pointed out manifest information. I'm telling you there's a value line. I can get a little bit of information from Yahoo and Zacks that's online, but for the most part, I'm kind of sailing on my own right here. Most recent quarter, that's great sales growth and tremendous earnings growth, not much to grouse about there. So I find that the earnings dots fall into my number that I chose. Next slide, Mark. And the numbers that I chose were 14% sales growth going forward, and I used 12.2 after using that 14 with a preferred procedure. Yeah, I could have used 12, I could have used 13. I probably would have been comfortable at my club with 11 even, but I'm going to go with around 12 right there. Three nice green trend lines in the evaluating management section. They don't have huge profits, but the profit margins are moving generally in the right direction. That's up, and the most recent profit margin is certainly higher than the 5-year average. A good solid return on equity, and the most recent at 16 puts it in a really good category, and doing it with very little debt. Keeping the debt to capital well under 10%. And I like all of those numbers enough to continue the study. Next slide, please. I like to use this graph when I'm flying blind. And I am flying blind with this company. Again, not a whole lot of analyst information readily available. So I went to the quarterly tab. That's the tab right in the middle of the SSG that a lot of you ignore. Click the quarterly tab, and then I picked quarterly numbers. I asked for it to graph sales growth and earnings growth. Are you seeing that I'm asking for the green back stuff to appear on the graph? I'm looking for the last 5 years. And then because a couple of these numbers actually went over 50%, I said limit the growth to 50% so I get enough of a scale on the left-hand side that I can actually see what's happening. What I was trying to do was reassure myself that the hurdles that I set for sales and earnings are reasonable hurdles for the last couple of years. Those hurdles are represented by those horizontal lines across the graph, the green one for sales, the blue one for earnings. And notice that for the last 7, 8, 9 quarters, I've stayed at or above the green line with the green dots, and I've stayed at or above the blue line with the blue dots. That tells me that my values for growth are probably fairly reasonable, maybe even a little bit on the conservative side. Next slide. I pulled the grid off the SSG right here, and I'm telling you the numbers I used. I'm telling you that because the PEs were really packed pretty tightly, I felt the averages were great numbers to use, so I used them. Would I have minded if you chose 22 or 23 or 21 or 25? Probably not. Would I have minded if you went down to 11 or 12 or up to 14 or 15? Probably not. But this is my SSG, and I chose the averages right as they sat to do the arithmetic. Next slide. What I got was a good solid buy, total return of 21.5%. Remember, that's best case scenario. Par, selling it at the average PE 5 years from now. Still, that's a great par, 16%. Compares very favorably to Manifest's par of 17.7%. Manifest is doing exactly the same thing that I'm doing. The Manifest numbers are coming from the exact same process that I'm using on a stock selection guide. I captured from Morningstar the fact that it's a 5-star, but I think Morningstar's 5-star and 4-star ratings are a little bit misleading. They're not talking about quality, they're talking about how much above or below fair value the stock happens to be trading at. You go a lot above fair value, you only get 1 star. You go a lot below fair value and you get 5 stars. The fair value price is 131.74. Right now, the closing price from, I don't know, a day or two ago was just under $96. So I think it has room to run. I think it's in the kind of industry that definitely has pricing power should inflation continue. And I also think it's in the kind of industry that will be selling its products even if we move into a weak recession. Remember, remember the talking heads have been predicting recession now for over a year, probably the most widely telegraphed recession that hasn't occurred in history. But let's give it a chance. Eventually they'll be right. I think Fabrinet is a wonderful stock to add to the portfolio.
Yeah, and they probably benefit pretty well internationally from economic recovery too. Good stuff. Thanks, Ken. All right. My presentation tonight is not on Generac, but I thought I would go back and relive a painful moment with Candace.
Yes. I went down in flames and took you with me.
I actually think we were right. We were just early.
Okay, good.
Okay. I really like the Generac story in general, but one of the things that I always try to go back and look at this sort of thing, and there's an excellent article on catching falling knives from Ian Casale at Microcap Club. I would the link is right here if you want to go and take a look at it. And he laments, these things do happen. Keep in mind that the stock had actually tumbled from here down to here when Candace and I picked it. So we had already seen that type of a decline, and I thought it was enough. I thought it might be turning the corner. It's a pretty good long-term story. What they ran into basically is a lawsuit that kind of interfered with some of their commerce, and it wasn't a big material lawsuit, but it was big enough to bother a lot of people. The other thing that I think I probably will notice more in the future going forward is during this entire price run-up, you have all this volume down here. Notice the dark bars. That's basically increasing volume with increasing price. You want to think of it that way. So a lot of people were investing in this company and making a lot of money going up. And so they're going to bail. Anytime the judge comes out, they're basically all bailing. And at the time we made our decision a year ago, somewhere in this time frame, there's not a whole lot of red bars here. Keep in mind that basically all of these darker colored bars ultimately have to be kind of offset. And notice how much offsetting that was done in a hurry here.
Yeah.
It's kind of, you know, that's a whole lot of downward selling pressure. And I mean, I would be tempted to go back into it at near 100. Candace, I figure if we liked it at 200, we should really like it at 100.
Yeah, right.
And so that's our story, and we're sticking to it.
Okay.
All right. And here's a look at the company. And again, one of the things that I try to learn as an investor is, you know, this thing is not falling apart. The wheels are not coming off. The returns are actually quite good now that the price has actually come back down to where it has. And there's nothing terribly wrong with the fundamentals. A little bit of a downdraft here in earnings, but the company is still pretty much intact. And I actually think it's worthy of consideration for purchase. But I basically heard a little whisper in my ear on the right here, and I'm reminded of a few situations. I've talked about this before, but the Mutual Club of Detroit invested in Corning back in the 1960s, and the premise for doing that was they didn't want to pick the winning television manufacturing company because there were, you know, 5 or 6 that were basically beating each other up, but Corning sold their product to everybody, kind of like Kevin was talking about a few minutes ago. So it's a matter of they didn't care who won. They just cared about TV sets being sold. Fast forward to BioVale, a company that in the early 1990s was talking about these things called virus and the coming internet. United Healthcare was an idea that we got from our investment club. We actually had the president of a small HMO in our club who recommended that we take a look at United Healthcare. Qualcomm in the late 1990s, when the analyst community had trouble figuring out what was going on with their royalty scheme. So these are things that just kind of whispered to me. FactSet Research, FDS, that was a rainy night in Boston. Rich Bobian literally pulled me aside in an alley and said, you need to check out this company, FactSet Research, FDS. And then there's Navtech. That's the company that it was a pretty neat story. They actually sold the technology to Garmin and the other companies that were duking it out in the GPS environment. So they were kind of a version of Corning happening again, and that was a very successful, quick investment. Ken has already described Neogen. Neogen was inspired by running into one of his former students, and he asked, she was a great student, what's going on? And she described this wonderful company. Actually, I'm talking about Simulations Plus now, but you know, basically this tip from somebody that's in the business. Well, very similar thing happened to me the other night. We were at a neighborhood gathering. We were talking to a gentleman that's responsible for some of the intense science and measurement stuff that goes on with electric batteries in Chrysler vehicles, and just talking about the precision that's required. And as Kevin has already pointed out, the huge volume of semiconductors that you have to get right. And he basically suggested this company called Nova that I had never heard of. It happens to be an indirect competitor of the company that Kevin shared. So I guess I have to thank Kevin and say what he said, what Kevin said about the semiconductor businesses. He covered the industry pretty well. So I did a very similar thing. I took a look at stock screen results using just my ivory screen, taking a look at the top 0.5% of all companies based on quality and par, just to see who shows up. Nova was on that list, even though it's a little bit more lackluster than some of the other situations on the list. And I'd filtered it further using the triple play. Again, channeling my hero, Kevin. And again, you get a pretty nice set of companies. Another one that jumps off the list here for me are these two. Again, they're involved in the materials and metals involved in electric vehicle and other construction. The semiconductor business, as Kevin has laid out, is going to boom. And we would like to be involved with the companies that are well positioned to do that, as he's pointed out. Here's a quick look at Nova measuring. Nova Measuring has a pretty solid track record, pretty much up, straight, and parallel, decent sales track record. Again, we're looking at a growth rate in the mid-teens here. We're looking at steady profitability in the 20% range. Lots of good stuff here. Again, returns in the mid-teens, excellent quality. There's two moments on this chart I want you to notice, that the downdraft in 2019 and the downdraft that we're currently in, that's producing a bit of a pricing situation, are shown here. And when these have happened, we've actually had relatively flat spots or declines in the stock price. Now, they also had a run very much like the one we were just talking about with Generac. That is shown here. Lots of strength here, lots of black bars. So I'm watching this closely, trying to learn from the Generac experience. I do see a pretty good offset down there. So here's what these guys do. You've already heard many of these terms. I'm not going to beat them up. They are in the same type of business that KLA is in. The metrology is a big part of their business, and that's simply just measuring stuff. What I find fascinating about this one is a little bit of a Corning moment. These guys are fairly well diversified, and they are present across a number of semiconductor lines, and you can see that it actually would be a shorter slide to put together who don't they do business with. And because most of the names that are on here, that you take a look at the largest by market cap in the semiconductor field, they're all right there. So basically you have an improving quality situation, a projected return or a return forecast that is near multi-year highs, a growth rate in the mid-teens, decent profitability characteristics, a projected PE in the low 20s, and again, mid-teens for the return forecast in a very high quality company. It's going to have some zigs and zags. That's just the nature of the business that they are in. So I'm going to go ahead and throw that on the pile. And I think we can open it up for a poll. I think it may be Canvas versus the other three companies that are kind of related. So maybe we're going to have a three-way split and see what happens. Ken, are you still with us? Ken?
I'm here, Mark. I had to leave for just an instant, okay? And I'll get this poll underway right now. Here we go.
We're wrapping up.
Sorry, everybody.
Oh, that's all right.
So here's our poll. We'd ask you to vote. We already have 20% of the vote in. We already have 40% of the vote in. So just make it easy. Just pick a company and tell us what you'd like to move to. 3/4 of the vote.
Ken, can they do like Chicago? Can they vote twice?
No, just once. Mark has suggested they can vote twice, but just once. Okay.
Well, if they say nice things about Stan Musial, they can vote as many times as they like.
All right. And I'm going to close the vote down in about 5 seconds. We're at 87% voting. And we'll close the polls. And we'll share the results. And we're going to add a position in KLA 10 Core to the portfolio.
Cool.
Fabrinet and Jack Henry got roughly even votes, and Nova is the fourth one on the list. So
bringing up the rear again. Now, I wonder if Ann Manning.
Well, you did beat Hughes' choice, so there, you got that going for you, which is nice.
So I wonder if Ann Manning is keeping track of how many times I finished last.
You may get an award for that one.
Okay.
I have a hand in the air, Mark, so I'm going to recognize this person real quickly, and then we'll kind of close things up, okay?
Okay.
Tom, you're self-muted. If you unmute, Tom Jones, if you unmute, you'll be able to speak to us. And he's still muted. So I'm going to take that hand down, Mark, and let's wrap this up, okay?
Okay. This coming weekend, Ken and I will be in Cincinnati with a live audience. We love the fact that some of that is returning, and we're looking forward to doing that with the Cincinnati Model Clubs and chapter down there. At the same time, Cy Lynch will be online representing or preparing a program for Indianapolis. The May Roundtable, I did put a date here. We'll have to itemize that date. I wanted to check and see how it compared versus Memorial Day. But just a reminder that shortly after Memorial Day, we do have the Better Investing Cyber Convention in those June dates. And then there are a couple other dates coming up. And I thought we would just leave this one just as an invitation. If you're anywhere within driving distance of Cincinnati, we'd love to see you in there. And the Cincinnati chapter is ready to welcome you with a hug in our open arms. And there's the program with Cy if you want to join one virtually. Interesting presentation there by the doctor on the current banking crisis. Be interested to see what his look is. Cy's presentation is on portfolio-centered decision making. Okay. Any other housekeeping that we need to do?
I think we're in good shape, Mark. I've kept up with the question log here pretty well, and we'll tell everybody that if we do change the date, it'll appear as the correct date when we send out our reminder. I see what you're saying about the roundtable being on a fifth Monday here, so we'll take a look at it real quickly, Mark. Okay.
Agreement on that. And with that, I just want to extend a warm thank you to our guest damsel hostess, Candace.
Thank you so much. Tonight. Thank you for the class that you did for us. Special. We appreciate it. Maybe next time we can do this in person.
we would actually love to get that list out and just jam in person. I mean,
yeah, that would be great.
And Kevin, as always, Kevin, thank you so much.
Glad to be with you. Thank you.
Yeah, Kevin, thanks a lot for stepping in at the last minute, Kevin. And Candace, your presentation was really, really well done. Thank you so much for taking the time. Very much appreciated.
I personally will be watching for accumulation opportunities with that one.
Well, I happen to own Jack Henry, and I'm happy that there's other people that think it's a great company as well. So. With all that, I want to thank our audience for being with us tonight. We couldn't do it without the audience. And if there's no more, I'm going to say good night on behalf of the knights and the damsels of the round table, and hope to see you again at the end of May.
Thanks, everybody.
Good night.
Good night.
Good night, all.